Hi everyone. Today we'll be talking about the 2026 Australian federal budget. There's been a lot of talk around CGT, negative gearing, trusts, and small business reforms. So today we're cutting through the headlines and simplifying it all. Joining me is tax and business expert Sandeep Bedi to help unpack what really matters. Hello, Sandeep.
Hi, Gureet. How are you?
Good, thank you.
Yes.
Thanks for your time today.
Thank you.
So people are calling this the biggest tax reform budgets in decades.
Yes.
In your expert opinion, what makes this budget such a huge deal?
Yep. Because it fundamentally changes how wealth creation through property, investments, and trust structures will be taxed in Australia. Historically, Australians benefited from the 50% capital gain tax, discount, unrestricted negative gearing, and the discretionary trust income splitting. This budget directly accesses all three areas. The government position is that the current tax system focuses on wealth accumulation through passive assets and property investment, particularly benefiting the high income earners, while making housing affordability for the younger Australians.
Okay, so let's start with capital gains tax. What exactly is changing?
Yep. Currently, if an individual is holding an asset for over 12 months, they get a discount of 50% on their capital gains. For say, if you are getting a gain of $200,000, you'll be taxed on 100,000. From 1st of July 2027, that 50% discount will be axed and will be replaced by an inflation indexation model. Instead of automatically halving the gain, the asset cost base will be indexed to the inflation rate, that would be CPI, and then the tax will apply on the real gain after inflation adjustments.
So is this effectively a tax increase?
In many cases, yes, particularly in the lower inflation markets. Under the current system, the people were getting a generous amount of 50% reduction in the capital gains tax, but regardless of the inflation levels in the market. But in the new system, they will be depending on the CPI increases in the market and the inflation levels. Now, if inflation is low but the asset growth is high, investors may end up paying higher tax on it.
So one shocking point people are talking about is pre-1985 assets becoming taxable. Can you explain that?
Yeah, absolutely. Historically, the assets acquired before 20th of September 1985 were fully exempt from CGT. But this government is proposing to bring them into net from 1st of July 2027, which were untouchable for 40 years.
So will people lose all their current CGT benefits immediately?
No, actually not. The government is proposing a transitional rule. Any gains accrued before 1st of July 2027 will attract that 50% discount on it. But any gains after 1st of July 2027 will fall under the new indexation method.
Negative gearing is probably one of the hottest political topics in Australia right now. Let us know what's changing.
Absolutely. It was a shock for everyone. From 1st of July, all the negative gearing deductions would be grandfathered. So which means all the rental losses that you accrue from the residential property you rented out would not be offsetting against your salary and wages income or any business income you accrue. Rather, it would be offsetted against the rental profits that you accrue in the future years and any capital gains you earn from selling those properties.
So who's still getting negative gearing benefits?
Yeah, the government is carving out an exception for a new build. So if you invest in a qualifying new build, you still get those benefits and you negatively gear that property against your income. The policy objective is clear. They want tax incentives to support the new build rather than increasing competition over the existing homes.
So what about current investors? Are they protected?
Yes, kind of. They have introduced a grandfathering provision for that. If you own the property at the budget night, specifically 7:30 p.m. Australian Eastern Standard Time on 12th of May 2026, the current rule continues to apply under the property. So existing investors aren't immediately impacted unless they purchase additional established properties after the reform date.
Now let's talk about discretionary trusts. What's this proposed 30% minimum trust tax?
This is another massive structural reform. Currently, the discretionary or the family trust is used for income splitting. So the family distribute this income to the low income earners so that they can minimize their taxes. But under the new proposal, they will be taxed at 30% from 1st of July 2028.
So even if the beneficiary earns very little personally, does it still get taxed at 30%?
Yeah, that appears to be intention on the budget papers. Beneficiaries would receive a non-refundable credits for the tax already paid by the trust. But the lower income beneficiaries may not receive any refunds. So, effectively, the government is introducing a floor rate to reduce the tax planning advantages of a discretionary trust.
So, what structures are excluded?
Fixed trust, super funds, charitable trusts, deceased estates, and widely held trusts are all excluded. So, the mainly target for the private, discretionary, and family trust.
So, what impact can these reforms have on the property market?
There's several possible impacts. Reduce investor demand for established homes, increase focus of new developments, potential moderation in house price growth, more institutional built to rent investments. The government is clearly trying to shift capital towards increasing housing supply rather than a speculative investment.
So, could rents rise because fewer investors are buying properties?
That's one of the major criticism. Critics argue that if investor participation falls, rental supply could tighten, potentially increasing the rent. Supporters argue that redirecting incentives towards a new construction should increase long-term housing supply and stabilize affordability.
Okay, so not all the budget changes were negative. What were the more positive ones for our small businesses?
There were several strong business measures: permanent 20,000 instant asset write-off, reintroduction of loss carryback, startup loss refundability, expanded venture capital incentives, R&D incentive reforms. So the measures were designed to stimulate business investment and innovation.
Perfect. So, what's the significance of instant asset write off becoming permanent?
It provides a certainty in the market. If you have an asset of $20,000, you can straight away depreciate that asset and get a tax deduction for it.
So, what relief did our ordinary workers receive in this budget?
There are three major personal tax measures: tax cuts already legislated, a $250 working Australian tax offset, and a new $1,000 standard deduction for work related expenses.
How do these $1,000 deductions work?
It simplifies tax returns enormously. Eligible taxpayers can claim up to $1,000 of deductions without any receipts or substantiation for covered work related expenses. If your work deductions are below $1,000, this could save a lot of administrative hassle.
So, Sandeep, what's the broader economic message behind this budget?
Yeah, the government is trying to rebalance the economy away from the passive wealth accumulation and towards the productive investment. The reform aim to improve housing affordability, increase housing supply, reduce tax minimization opportunities, and strengthen business investment, and improve the budget sustainability.
And lastly, Sandeep, what should our investors and business owners be thinking about right now?
Planning. The budget creates a major strategic considerations around the asset disposal timing, trust restructuring, property acquisition strategy, tax effective investment structures, business succession planning. Many people will likely seek a professional advice before the 2027 implementation dates.
This has been an incredibly insightful discussion. Clearly, these reforms could reshape the Australian tax landscape for decades to come. I'd like to thank you all for joining. I hope we were able to shed some light on this new budget. For any tax-related inquiries, please visit our website at www.sbwta.com.au or call us on 0485 882 175.